Hi, everyone. This is Tim Melvin of the Deep Value newsletter and the Banking on Profit service, coming to you from back down here in Central Florida. I've been up in Atlanta the first part of this week at the FIG Bank Stock CEO conference, and I'm going to come back to that in just a minute. But even when I would come down here a couple times a year to Florida from the Mid-Atlantic, when I lived up in Maryland on Kent Island, I always loved driving in the Deep South because Deep South, South Carolina, Georgia, Florida, Alabama, they're a little more lenient than the rest of the country on billboard policies. And really, there's almost an anthropology or sociological study that can be done just by the billboards driving through the Deep South. Now, we used to come down on 95. Today I went up, or this week I went up on 75, drove back down it today. And, if you took an alien and you said, okay, here's a car where you're just going to have you drive from Atlanta, Georgia down to Tampa, Florida, and, you can make your impression pretty much just by the signs on the side of the road. Well, they would come back convinced that the American economy and lifestyle was completely driven by peaches, pecans, baby alligators, hamburgers, breakfast sandwiches, massage parlors, strip clubs, and churches, because that is the preponderance of the billboards all over the Deep South. I'm sure there's a whole book in that for somebody that wants to write it as a commentary on the American culture, but I've always gotten a kick out of it. The billboards here in the Deep South make for a very interesting drive, to say the least. Now, I was up in Atlanta, and I have to say that, like most of the bigger cities in the United States, Atlanta's hopping. There's cranes all over the skyline, lots of building going up, new office towers, new condo buildings. Now, I did have a conversation with a fund manager at the conference. It was very interesting. He's based in Atlanta. It was in his home market, and he told me that most of the building he thought looked pretty good. It was new residences going into high demand areas, office buildings, where they should be able to meet demand. But he did say that a couple of developers, and these were guys that were not necessarily as experienced with the market, were building south of downtown. Now, I don't know Atlanta at all, so I have to take this gentleman at his word. He said that's really not a highly desired place for more affluent folks and millennials to live. And he really thought that the condo towers going down there might face a very hard time getting leased up at acceptable rates. I found that kind of interesting, and we're going to do a little investigation and see who the builder is and exactly who financed these projects. But everything I saw, the streets are crowded, traffic is ridiculous. I was coming south out of Atlanta this morning at about 8 o'clock, and the traffic north going into the city was about as bad as I've ever seen. It was right up there with New York City and Washington, D.C., just as far as an absolute bottleneck of traffic. Lots of folks going to work in downtown Atlanta. So Atlanta is jumping. However, when you get outside the major city zones, and I've always been big on kind of just observing. I think driving up and down the highways and stopping in the towns and talking to folks is probably a much better way to judge the American economy than talking to your average economist who has not been outside since he got his college degree sometime in the mid-1980s and is basing everything off computer models. But if you just look at roadside hotel pricing, truck traffic, because ultimately just about everything we use in this country is delivered at least the last couple miles from the rail yard to the store by truck. Truck traffic is steady. It's there. It's nowhere near what it was back in 2006, 2007 when I used to make the drive down south. So, if you look at hotel pricing, it's still, I think, in the mid sector, traveling hotels, it's still very weak. I saw some incredibly cheap signage that's going up and down the road for, marquee nameplates, priced under $100 a night. The lesser chains, the Comfort Inns, the step down, the family size hotels, we'll call them, they were incredibly cheap as you moved between Atlanta and Tampa. And just, roadside restaurants, not a lot of construction along the interstates in the smaller cities and towns going through Georgia and Florida today. And it just driving up and down the road, you get the impression that outside the urban areas, what we have is exactly what I've been talking about all along. An economy that's better than it was, but it's still not great. It's not a super strong economy. Now, a lot of the bankers, by the way, at the conference kind of affirmed that in some of their comments in the various forums. And of course, I do in-depth research in the hallways and afterwards at the bar. That's some of the best research is done over a couple of adult beverages I found at these conferences over the years. But that's kind of what they saw. Their economy's okay. It's not great. Now, they do think that in spite of that, several bank CEOs said, look, there's no economic justification to increase interest rates, but they kind of have to. One gentleman in particular said, look, it's like this. They got to raise 25 basis points this year, and at least that much sometime in the first half of next year, because the simple truth is they need to get some arrows back in the quill. There's plenty of economic concerns around the world, and he particularly highlighted a few geopolitical hotspots that could cause serious economic disruption even here in the United States. And he pointed out that, look, if that happens, they've got nothing to fight with right now. They have no dry powder except another round of QE4, which could be devastating for the markets. Better to be able to come back down 25 or 50 basis points that you had previously hiked from the zero level. So a lot of the banks think, yeah, they're going to raise. It's going to be slow, pretty measured. It's not as much about, hey, the economy's doing so well, we're going to raise interest rates. It's about if something goes wrong, we have no tools at our disposal. We got to take rates up, primarily to protect the economy if we have to bring them back down in reaction to some geopolitical event. I thought that was a very interesting comment and takeaway from this conference. The other takeaway was that most of the folks that I talked to at the conference, most of the CEOs, these were larger community banks and smaller regional banks. I'm going to say, $5 billion and up in assets were the preponderance of the speakers and hallway roamers at the FIG conference in Atlanta this week. And they are all acquisition minded. Virtually all of them have been making acquisitions. One gentleman from Home Bank in Arkansas, Conway, Arkansas, they've made 19 acquisitions in the last few years, and they're looking to make more. But there's some hedge fund guys there, some analysts, of course, some traders from FIG Partners. And everybody I talked to, I kind of got the conversation around to where do we see all of this going? And what happens to the smaller banks under $500 million in total assets? 100% agreement. They may not know they're for sale, but they're for sale because very few of them are going to be able to remain independent. Regulatory costs are a huge driver of that. So is slow loan demand from, just an okay economy. And the other thing that a lot of people talked about, in fact, there was a special panel on it, and I'll be sharing more of that with subscribers on Friday. Cybersecurity costs are rising, and they're rising quickly, and it's an ongoing cost, and it's non-quantifiable. It's a huge issue for the smaller banks. They're going to have to look for scale by moving up. I talked to one gentleman. His bank's about $550 million. It's actually in the Banking on Profits portfolio. And he said, look, we're aware of it. We know it. We have to either do a deal, and I don't think that's an option because their currency, the bank stock prices, it's weak, it's under book. It's going to be hard for them to find somebody willing to take that as part of a deal, or we have to sell this bank. He was, quite open about it, as a matter of fact, that at $550 million, it was just going to be tough. A lot of the folks I talked to said the floor is actually a lot higher than $500 million. They think it's $1 billion, maybe even a little over $1 billion. That if you can't get to that size, odds are over the next few years, you're going to have to sell your bank, if not sooner. Now, when talking about M&A, I said all of these guys are looking to grow. Loan demand and organic growth is still very weak, so the pathway to growth is acquisition. And again, targeting that sub $1 billion in assets banks that make up the bulk of the Banking on Profits portfolio right now. One banker, he was almost $25 billion in assets, but he said, look, I would rather buy 4 or 5 banks with less than $1 billion in assets than one $5 billion bank. I get a much higher cost takeout from the smaller banks, and it's also a lot easier, quicker, and less expensive to integrate the organizations by buying several smaller ones as opposed to one larger one. As we get down the road and more of these under $1 billion banks begin to disappear and they're going into $3 and $4 and $5 billion banks, that merger wave is going to come down. You're going to get the roll-up effect of the billion-dollar bank buying the $500 million bank. It'll start with the $500 million buying the $300 million, then get bought by $1 billion, then by $3 billion, then by $5 billion. One banker told me his estimate, his model showed that this consolidation wave, and I'd love to see the inputs to this, but this was a barroom conversation. So he thinks that 12 years at least is how long this consolidation wave is going to last. So the banks that end up, of course, at the top of this thing a dozen years from now are going to be super strong, super high quality, super fast growing banks. And if we ride the consolidation wave all the way up, and that's exactly our intention with the banking on profits portfolio, then we're going to own just these super regional banks at fantastic prices created by mergers, and we're going to have made serious walkaway retirement money over the next dozen years. So I'm pretty excited about what's coming. We've got a good 2 to 5 years, if not longer, of being able to own just these little baby banks. And it's almost an arbitrage. We buy them at 85% of tangible book value. Current multiples are about 1.35. So just selling there, buying here and selling there, the book value growing in between, that's going to make us plenty of money. But as I said, the M&A wave goes on for a very, very long time in the small regional and community bank space. So we're pretty excited about that. Love to have our optimism on the sector echoed back by the bankers themselves, some of the top bank stock hedge funds. We're at the conference and we're saying pretty much the same thing. And of course, the analysts who follow the stock also kind of share that opinion. So we're not walking in the wilderness. This is a pretty well thought out proposition in the community banks. If you're not investing in them, I really think that you're probably making something of a mistake, because this is incredibly lucrative and, as I see it, low risk. As one banker said to me, and a gentleman's been in the business a good long time, I think he said 25 years, he said, look, this is a simple business. And his bank, he pointed to his bank in particular during the credit crisis, said, our stock went down a little bit, but it didn't go down a lot because we didn't do stupid deals. And he said, it's that simple. If you just get up, go to work every day, don't do anything stupid. Banking is a pretty easy business, and the stocks can be compounding machines. Now, this individual also said one other very interesting thing to me, because it goes to the mindset of an investor. He said, look, when his stock went down in 2008, he said, I know we didn't do anything stupid. I know we had good loans on the books. We had some problems, but nothing that could not be dealt with internally. So he just simply bought more stock. And he said, look, it's done well since late 2008 to 2009. He says, but I bought this looking out 20 more years. Not 2 years, not 5 years. Not talking about doubling my money. Talking about earning many times my money over an extended period of time. We kind of got into that discussion that most people come to the market, they're looking to make quick gains. They end up holding on to losers and selling winners. And I don't mean that just on price. I mean that on fundamentals more than anything else. And so they end up with a portfolio full of poorly performing companies because they sell their winners way too soon. They don't allow them to become those superior companies that can earn you 5, 10, 15, 20 times your money over the long run. That's the way we need to be approaching this, and that's the way we need to be looking at these small community banks too. With a very long ramp, this average 7-month holding period that we have for stocks right now is absolutely ridiculous. Selling a stock in 7 months just because it's gone up is like selling your house in 7 months just because it's gone up a few percentage points. It's absolutely ridiculous. Anyway, I did also get a chance to talk to a few bankers that had oil exposure, some Texas banks and Louisiana banks. And they said, look, the industry's used to price swings. They've seen it. Okay, oil prices swing wildly all over the place. But if this continues, this very low pricing, and maybe possibly even lower if the Saudis really decide to step on the, forgive the pun, gas here, then it's going to get a lot harder to deal with. They're already seeing some asset sales, some companies putting themselves up for sale to pay off the debt. A lot of them are very levered. Expressed a pretty sound degree of confidence that most of the bank loans in this stuff, they're going to be okay. There'll be some defaults and losses, but not horrible across the banking industry, even for those with some exposure to the Houston and the other really energy-dependent markets. Where they point the fingers, like, look, junk bonds and high-yield financing, that could be problematic. If oil stays down here too long, we are going to see defaults. That's going to be a problem for the bond market. It's going to spill over into and be a problem for the equity markets as well. None of them had a high degree of confidence of when oil prices would go back up, but they did worry a bit about long-term spillover into the community as far as jobs and that type of thing. Interestingly, one gentleman from Houston did say, look, that could happen. He said, well, we're not too concerned about it. Yes, we're energy dependent, but there's a lot more going on in Houston than just energy. So he was pretty confident that even if those banks took a bit of a hit in the long run, they'd be okay. We're watching that closely because we love the state of Texas. My wife, of course, being from San Antonio, we love going down to Rockport, Texas in the summer times. We think it's a great state. Not out of the realm of possibility we end up living there at some point in the future, although still gunning for the Keys. I'm hoping to win that long-range argument. But Texas has a lot going on. There's agriculture, there's technology, there's biotechnology, there's education. It's a very vibrant economy even without energy. Throw energy in there and it's an even better story. So if oil prices stay down here, we start to see some of these Texas banks, all of which, by the way, are trading at a premium to book value. If we start to get them back down below book value, well, I'd sure love to take that 10, 15-year view of things and buy some of these higher quality Texas banks below book value. So we're watching that pretty close. So anyway, that's been our week. We drove up Monday. It was just a fantastic conference. We learned a lot. We talked to a lot of people, really reaffirmed our view of what's going on in the small regional community banks. This is probably the best investment opportunity in the current market and maybe one of the best you've seen in your lifetime. And I will mention that the hedge fund guys that you talk to and the bank stock specialists, they have a little bit of kind of an I know a secret type air about them because they do. And they're earning tons of money. Everybody I talk to that's a bank stock specialist is up solidly this year, just like we are in banking on profits. And they've had a great 5 years, and they're looking forward to a great another decade as conditions in the banking industry continue to improve. However, for the smaller banks, they're still going to be facing substantial consolidation. Also a consensus that if the economy should slip back towards recession, it's going to be the best news possible for small bank stock investors. Because guess what? It's hard enough to remain independent right now if you have less than $1 billion in assets. Let this economy slow down and the for sale signs are going to start to go out. And again, buying at 85% of tangible book, selling at 1.35 times tangible book, I will do that all day long. Anyway, while we're on the subject, this is the last day to subscribe to Banking on Profits at the current $3.99 for a year price. Now, we've covered that. You get the newsletter, you get the guided portfolio, the regular weekly commentary, you have full email access to me with any questions and concerns that you have about any banks, the markets, investing in general, whatever it is you want to talk about. Sometimes it's a one-liner because I'm busy, but I do always get back to you as soon as I possibly can. And I've even gotten some friendships that have sprung up out of these email exchanges over the years, and I hope we get a lot more of that in the future. I like to see Banking on Profits is not just a subscription service, but a community of like-minded investors. But anyway, this is it. Today is it. Be $3.99. You get that. You get the monthly service that has some more statistical stuff and kind of a bigger picture view. And we'll talk about a few banks a little bit more in depth each and every month. And that's complimentary. We charge $99 for that. That's probably going up next month as well. Look, this is high quality investment coverage. You're getting something you can't get anywhere else. We have to limit the number of subscribers or we make the space too crowded because we are dealing with some very small banks. So to continue to put forth the effort to make this the best possible service, I can either go out and sign up a whole bunch of new subscribers, which is damaging to all of us, or I can raise the price. So I went with that option. But anyway, today's your last day. Tomorrow the price goes up. It goes up to $1,000 a year. You can get it for $3.99 today. And I'll put a link in the commentary section, but you do have to sign up before midnight today because after that the price goes up. And hopefully this will be the last time we raise the price for the foreseeable future. But anyway, this is Tim Melvin, Banking on Profits and Deep Value Newsletter Services, coming to you from back home here in Central Florida. Looking forward to a fantastic rest of the week, and I hope you do the same. Thanks for watching.